Thank you to everyone for making the time to join us for this important session on investment strategy post-COVID suppression. For those of you meeting me for the first time, my name is Paul Ashworth and I'm the Chief Investment Officer and Managing Partner at Cameron Harrison. Today I'm pleased to also be joined by our Director of Research and Investment Management, David Clark.
Thank you, Paul, and thank you everyone for joining us today.
The title of today's discussion is deliberately described as investment strategy beyond suppression. Suppression strategies lay at the core of today's economic, commercial and financial futures, with their implications extensive over the next 5 years and beyond. The term suppression is evolving in its meaning as governments themselves shift their health and political objectives. It also is an economic strategy with increasing economic and financial market reach and implications. We think their medium-term economic consequences are yet to be fully appreciated by the community, let alone hit the economy. In the near term, the economy will bounce from this decimated base, but it is the lag effects from 6 to 24 months that we think are underappreciated and underestimated. In particular, bank bad debts and constrained credit growth occasioned by higher unemployment and higher underemployment being at 20-year highs. Perhaps most crucially, it's the expectations of the last 30 years which will need to adjust, particularly in terms of bond yields, which declined over this period to near zero. We are not epidemiologists, so we won't use valuable time indulging ourselves in our personal science views, other than to say that suppression has been presented to Australians as a process to keep us in a holding pattern pending vaccination. And this assumption concerns us. From a risk management perspective, our mantra is always, the danger lies in the assumptions. In this instance, the assumption that a vaccination can be developed over the next 18 months should at best be a 25% likelihood, and it is certainly not our base case. We think this needs to be seriously challenged. We are somewhat, however, encouraged that the federal government's narrative is turning to COVID management through testing, tracking and healthcare preparedness. This is more realistic and acknowledges that this is potentially a much longer health issue that needs to be managed. Australia finds itself well positioned at this juncture, with the National Cabinet having crisis coordinated well. The level of direct stimulus, both here and in the US, has been exceptional, which we can see before us. And this has buttressed household income and, to a lesser extent, business income. Combined with supportive central bank action here in the US and in the UK, the economy has been provided immediate liquidity. An economic and financial crisis has been averted. Australia finds itself now well positioned to lift its suppression stages to stage 1. And we can see this in the top right-hand quadrant. Our level of testing, tracking and health system preparedness appears to support easing and lifting of certain suppression strategies. This brings us to how we're considering and setting strategy over the next 3 to 6 months. But more importantly, to how we view the economy and financial investment beyond this immediate crisis. It is, we think, a new world, which frankly, the COVID crisis has just brought on earlier, but which in many respects was before us in any event. David, balance of risk assessments is very much at the core of our analysis and processes. How do you see these moving forward? And how does Cameron Harrison incorporate these assessments into both our strategy and our actions?
Thanks, Paul. Very important questions. Since the COVID-19 crisis began, I've had the opportunity to speak with a number of different investors. And the common theme across each of those discussions has been three key questions. What's different this time? How do we see the current financial and economic risks? And what are we doing for our portfolios to position them both in the near term, but also for the long term? So starting with the first question, is it different this time? I think the answer to this is yes. If we compare what's happened so far to previous recessions that we've been through here in Australia, the GFC, .com and the recession that we had to have in the 1990s, it has been very different this time. The primary reason for this is the speed at which markets have corrected from their highs in late Feb to their lows in March. Typically, this period will take a number of months or years, with it taking at least 6 months before policymakers acknowledge the issue and more time before action is taken. In the case of COVID-19, the health impacts have preceded the economic impacts. This has allowed policy support to be deployed in a timelier fashion and on a scale, as Paul noted before, not seen outside of wartime. The measures have been successful at flattening the curve, and they've most likely eliminated the risk of an economic depression. As attention now turns to the lifting of these isolation protocols, with infection rates near zero and the load on emergency departments not significantly above normal, we're going to start seeing a world that looks like an economic recovery. This is the opinion that's been reflected in markets, which have rallied strongly since late March. But in our opinion, they are a little bit over-optimistic, and we see a number of economic and financial risks there. Investment risks tend to be a bit like icebergs. On the surface, everything can appear to be fine, but danger often lies beneath. The rate of policy response so far has meant that the true economic impact has been hidden. Normally, at this point of a crisis, we would have a strong understanding of unemployment, consumption, credit growth, and trade. But as it currently stands, the impact to these remains unquantifiable. For example, the most recent unemployment rate data still hovers in the low 5% range, yet we know 3 million Australians are currently on JobKeeper payments. This represents over a quarter of Australia's workforce. Many of these workers will return to work with their current employers, but from our discussions with business owners, we know that many of these JobKeeper workers will not be returning, and this is particularly true for the hospitality industry. I think it's worth remembering that the Australian economy was in poor shape leading into this crisis, with high underemployment, very low wage growth, and very high household debt. These factors led us to reduce our allocation to Australian equities in January of this year. And it is this build-up of economic sludge that will inhibit a V-shaped recovery in Australia. If the recovery is not V-shaped due to either a second wave of infection or other cause, then the forbearance shown by banks so far will dissipate, and they'll have little choice but to exercise their right to bring in security lending and lead to foreclosures. Under this scenario, the risk across different sectors is uneven. Finance providers and banks will be significantly impacted, along with discretionary consumption and travel industries. And it's these risks that have shaped some of the actions that we've taken in our portfolio in recent weeks, such as reducing our already low allocation to banks from 8% down to 4% and exiting out of our more discretionary consumer investments. Which turns to how the portfolio has been performing since this crisis began. So on this slide, you'll see the performance of our core economically responsible asset allocation strategy against the ASX 200. I think what we noted in earlier in this financial year is that equity markets around the world were running quite strongly. And through our 2 monthly rebalance program, we'd taken the opportunity to take some of these gains and reinvest across lower risk asset classes, principally interest-bearing securities and cash. This meant that we came into 2020 in a slightly lower risk position than we might have been. And then we also took the further decision to reduce our exposure to Australian equities, which has really positioned the portfolio quite well. And you can see in that graph that throughout the second half of 2019, we're able to move up with the market and bank a lot of those gains. And then when the downturns come in February and March, the ASX has gone down close to 20% since the start of the financial year. We're closer to 8%. And at the end of April, that number will be closer to 4 to 4.5% for most investors. I think it's worth remembering that although a global pandemic and economic isolation are new, market downturns are not, and this is the fourth such occurrence that our portfolio managers have faced. The first being the recession that we had to have, followed by the dot-com and then the GFC. These crises tend to happen every 10 or so years, and while they are all different, there are some common approaches that we have employed previously and which we're using again. These are principally a dynamic asset allocation. As the investment environment changes and we shift from one growth paradigm to the next, you'll find that different asset classes will perform better or worse, or be more impacted or less impacted. The ability to take on new information and respond and change your asset allocation in this type of environment is highly important. Much like different asset classes are going to perform better or worse, the same can be said of industries. So normally we are bottom-up stock pickers, but during a market transition that we're currently going through, it is important to take a top-down industry view as well. This is partly why we've made the changes that we had to our exposure to banks and finance providers. And I think it's important that all investors be mindful of this. Third is a quality bias. We always have a quality bias across our portfolios. It's part of our investment philosophy. But in difficult economic environments, such as we find ourselves, management teams need the time and the ability to adapt to running their business and not focusing on how they're going to fund their business. So having businesses that have a robust balance sheet is of high importance. And finally, it almost goes without saying, but maintaining a diversified portfolio is essential in this type of conditions. The combination of these factors has led our outperformance over the last 20 years since early 2000, and that's shown there on the graph against the benchmark performance.
Thanks, David. As David's mentioned, we had very conservatively positioned our main core asset allocation strategy over the last 15 months and again in January. Broadly, our position has been that the next 30 years would look and behave very differently to the last 30 years. And in many respects, COVID has brought forward this pivot through this, I suppose, what you could call 100-year exogenous shock. So what does this new world look like? It's not necessarily bad, but it will require business to employ deft management and strategy, governments to employ brave policy, and most importantly, for all participants, but specifically investors, will need to question and probably alter the economic and financial assumptions that we have all operated for the last 30 years. Fundamentally, it is to acknowledge that it is the end of Easy Street. So what does this mean for the economy post-COVID? Well, firstly, it's the end of a 30-year bond bull market run, which has delivered correlated returns for bond, equity, and property investment. With sovereign bond yields at or near zero, this path is at an end. It doesn't necessarily mean that yields will dramatically go up, but it does mean that the rate of change downwards in yields has finished. Secondly, in past shocks, wars and recessions, households have exited these situations with relatively low debt and leverage. And activity through consumption demand was able to re-engage. What is different this time is that both governments and households do not really have this capacity, given the extent that they have leveraged them themselves since the GFC. Basically, household balance sheets and consumption demand were shot going into COVID. They're going to come out of it worse, with prospects for wages and salary growth pretty poor. Fourthly, these factors cause us to be more pessimistic on the banking sector than consensus views. And this is largely because we think the level of unemployment will settle above 6.5% and be accompanied by a further downshift in average hours worked and hence increased underemployment. With long-term interest rates and short-term interest rates through monetary policy having declined to 30-year lows near zero, the potency of monetary policy has been muted. This now leaves us with fiscal policy and increased government spending and implicitly involvement in the economy. We can see here that the US government debt is approaching and will likely exceed the levels of World War II peak debt. In Australia, government debt will approach $1 trillion. Sobering, given that the pre-GFC Australia had near zero net debt. The scale of COVID's fiscal stimulus is unprecedented, and it currently stands at US $10.6 trillion. From an inflation standpoint, we do see little pressure over the next two years or so. And this is largely due to the spare capacity through both higher unemployment and underemployment. And finally, something that is less immediate and tangible to see is the potential for continued free trade and trade liberalisation being reduced. In particular, China has been at the heart of supply chains for countries and businesses around the world for the last 15 to 20 years. Business risk management, we think, and geopolitical pressures are likely to see a shift to other venues, if not back to local economies. So what does this mean for industry and business? There'll be some tough and brutal adjustments. Some have already been happening, whilst others you could argue were overdue. We would highlight a few key items that we think industry and business will need to address and that investors should be looking for. Firstly, the retail format was already under substantial change, and this will accelerate with further pain for physical retail format, such as malls. Secondly, the businesses will need to incorporate further resilience, both from the supply chain to financial buffers. The implications go to levels of working capital, leverage, structure of further long-term debt, and the development of even more advanced financial risk management tools. Thirdly, a demand and risk management preference to source inputs locally. Fourth, a renewed drive for efficiency. Necessity is the mother of all invention, and nothing brings out necessity more than a crisis. This is a key element of business and industry evolution and is probably, in due course, a net benefit. And finally, and related to efficiency, is that capital will become scarcer and capital will flow to the brightest and most promising. Low interest rates have permitted the weaker and marginal businesses to just exist. We would expect that these businesses will fail. And whilst this is brutal, it is again probably a net benefit for the long term. So in summary, The three key elements that we invite are firstly, that our asset allocation and asset strategies entered the COVID crisis in a very conservative posture. We were concerned with key elements of household balance sheet and monetary policy settings. Whilst we were clearly not anticipating a COVID-like shock, we were nonetheless prepared for it. This sees a quite muted impact on client wealth positions when compared to the larger, broader declines in markets. And that this places our strategies and client wealth positions to be able to carefully navigate the balance of risks ahead. Secondly, that our balance of risks analysis and its incorporation into our strategy settings continues our partners' successful 40 years navigation of economic and financial market crises. And finally, that beyond the COVID crisis and the lifting of suppression policies, that there will be profound changes to the economy, industry, and businesses. As we've noted, many of these changes are already on foot, others imminent, and due to this crisis, other changes which will spur new innovation and better ways of operating. But most of all, the easy street gains and the expectations of the last 30 years will need to substantially alter and change in all participants' minds. Again, we'd like to express our thanks and gratitude for joining us today. The presentation materials are available to download, and we'd be happy to discuss further with anyone. Keep well, and we look forward to meeting you down the track, hopefully face-to-face next time. Thank you.